It looks like we've reached that point on the crypto timeline when all of the DAO token holders are expecting to be able to flip the fee switch. But some DAO members are finding that walking through that door may be wrought with more liability than they bargained for. Ready? Let's go. Today, we're going to discuss DAOs, fee switches, and the possible dangers behind that door. Some news on Cardano, Metaverse Money, Messari on operational decentralization, the Bureau of Labor Statistics massively revising their numbers, and some surprising block production in Cardano. If you routinely patronize bars that have entrances that look sketchier than this, or if you're finding value in these videos each weekday, please consider delegating to the Army of Spies stake pool, ticker AOS. It looks like we've finally reached that part of the crypto movie where all of the DAO members get to do what they've wanted to do all along. It's not for the sheer joy of participating in governance that a lot of DAO members were so happy to gobble up those governance tokens. That's not why they acquired those governance tokens. Whether they had to jump through a bunch of hoops in a Discord to get the governance tokens or buy them or whatever they had to do, actually use the platform, whatever it is they had to do to acquire those governance tokens. The reason they acquired them was not because they have this pure euphoric feeling when they participate in governance. It is because they were looking forward to the day when they could utilize those governance mechanisms to flip the fee switch. They wanted to make some money. That is the real reason people acquired governance tokens. And now we've reached the part of the crypto movie, the DAO story part of the crypto movie, where the DAOs are all mature enough that the demand to flip the fee switch must be satisfied in some way. Obviously, there are different timelines on DAOs, different sort of birth dates of these DAOs. And, they're not, they're all on kind of like their own little timeline. But a lot of the DAOs are kind of getting that point where the fee switch is a very important topic. And surprisingly, not all of the DAOs, including gigantic ones like Uniswap, not all of them are deciding that it's safe to go through that door. Uniswap has actually approached this issue a couple of times, including a vote last year and a vote to solicit feedback that concluded just today. So the options were for community members to charge liquidity providers with a fee equivalent to 1/5, 1/6, or 1/10 of pool fees across all Uniswap V3 pools, or to not switch fees at all. And the community was pretty divided. It looks like about half the community was in favor, about half the community was not. But the reason the roughly, half of the community, whatever the exact percentage was, the reason those parties were not in favor of flipping the fee switch is not because they hate money. It's not because they're super altruistic individuals who just hate money. It's because they were afraid of the liability that might be involved with walking through that door. So what kinds of risks are we talking about here? Well, if you were to ask, your average 19-year-old uni token holder living in his mom's basement, he'd probably be like, the risk is that we're not going to get those fees. The risk is that if we don't flip the fee switch, we're not going to get all of that money. But if you ask a more sophisticated investor, somebody like A16Z, so obviously we talk a lot in Cardano and a lot on this channel about the negative side of VC investment in crypto projects. But one thing we could also say with some level of certainty is that A16Z is probably more well informed on legal, tax, and regulatory liability than your average 19-year-old crypto investor living in his mom's basement. Nothing wrong with living in your mom's basement, but I'm just saying A16Z probably spends a lot more money trying to figure out these types of liabilities, and they probably care about them a lot more. They have a lot more to lose. They're a sizable entity, and they have a sizable investment in Uniswap. So here, A16Z is laying out what they think the risks are. Risks associated with commissions. Generally, there are regulatory risks associated with taking commissions on the trading of assets. Though, as indicated in the Uniswap Foundation's posts, most of these can likely be addressed by limiting commissions to trading pairs with an unambiguous status as not a security. Given what we know, so this is back in December of 22, given what we know about the current SEC, what level of confidence would you have in saying this crypto trading pair is definitely not a security? Because unless your unless your trading pair is like, I mean, people would obviously cite, trading pairs like, you know, Bitcoin dollar, Ether dollar, they pretty much just those two trading pairs. But I think with the current SEC, it's even hard to have a high level of confidence about those trading pairs. I think the number of trading pairs that you can have a high level of confidence about them having an unambiguous status as not a security is maybe even zero, because I'm not so sure that the current SEC, even if they've given indications in the past that maybe Bitcoin's okay, maybe Ethereum's okay, even if they've given those kind of indications in the past, I could see them turning around and saying, oh, but somehow if you're taking a commission on the trading of these assets, you're definitely violating securities law. So I'm not totally sure that there even is a trading pair in crypto with an unambiguous status as not a security if you're taking a commission on the trading of those assets. I'm not sure that even exists. And I'm guessing that A16Z is not even sure if those exist, but they're definitely citing risks associated with commissions. Because let's face it, it's called the Securities and Exchange Commission. It's the SEC, not just the SC. So they're very much concerned about exchanges. And I think they're obviously very concerned about decentralized exchanges, and they're not really buying into the decentralization as shield from regulation thing. So I think they're wise. I think A16Z is very wise to be concerned about this, because being this sort of platform that's, theoretically completely decentralized, and doesn't really have an owner, that's sort of one thing. And then if you've got an enumerated number of governance token holders, and all of a sudden they're making profits, they're taking commissions on the trading of assets in that exchange, you sort of enter a whole new arena. You're walking through this door where beforehand you had this DAO, and it's like people have these governance tokens and they're voting on things. And it all kind of still just sounds like decentralization. It kind of sounds, like something that doesn't look like a corporation. But the second those governance token holders are making a profit on every single trade that happens in every single pool across this DEX, they start looking a lot more like owners of a corporation, like stockholders in a corporation. And that's a pattern the SEC is very used to and very happy to regulate. It's a very different pattern than this sort of, DAO thing in the mist, that seems very decentralized, and it still looks like, this platform is ownerless. The second those DAO token holders start taking profits, they start looking like owners of this platform. And to the SEC and other regulators, at the state and federal level, it just starts looking like a corporation that's running an unregistered exchange. So I think A16Z is wise to be concerned about that. And then they talk about risks with the governance tokens themselves. They say the protocol accruing profits from trading also impacts the analysis as to whether any transactions of the governance tokens themselves, the uni tokens, could be deemed to be transactions involving investment contracts requiring the application of U.S. securities law. Like I said, the second the DAO token holders are accruing profits from the trading, you're walking, sort of from one place through a door to another place, and that other place, has it's going to make those tokens look very different to regulators. If those tokens entitle you to profits from this platform that's supposed to be ownerless and decentralized, all of a sudden people are going to look at those tokens very, very differently. Regulators, at least, are going to look at them very, very differently. They also say if the fee switch is turned on, then the DAO could have control over accruing profits, which could have implications for tax purposes. We believe so, and then they go into their explanation of how they think they can sort of try to mitigate that risk. But they make a good point. There's also some tax risk here. So they're saying, hey, if anybody's taking commissions on trades, this is something that is likely to have regulatory risk attached to it. Also, if accrued profits are attached to the governance tokens themselves, the governance tokens themselves could be deemed to be securities. Also, there might be tax liability for the DAO itself. And in a lot of cases, we have these DAOs that aren't necessarily attached to a real world legal structure, like the Wyoming DAO as LLC structure. A lot of DAOs aren't those kinds of actual legal entities. So you might have tax liability accruing within the DAO. The DAO might be might have some tax liability, and there may not actually even be a legal entity that can pay the taxes. These are all problems the second the fee switch is flipped in any DAO. And the more sophisticated participants in those DAOs are recognizing that these are pretty big risks, and maybe they're not worth the profits from flipping that fee switch. So Cardano DAO participants, be careful about flipping that fee switch. It's tempting, but it may involve more liability than you bargained for. You know what isn't more than we bargained for? That's Cardano decentralization. And Messari just published this article on operational validator decentralization. And Cardano does very well, as you'd expect. The first chart I'm going to show you here is node hosting distribution sort of by node. And as you can see just by the segmentation in this pie chart, Cardano is doing much better than some of its peers. You'll notice Ethereum is not really a part. There are a few references to Ethereum, but Ethereum doesn't show up in a lot of these infographics. This is sort of about the non-Ethereum proof of stake blockchains. If we come down here to hosting distribution by active stake delegated to those validators, you can see even on this parameter, Cardano doing significantly better in terms of distribution than some of its competitors. So Messari goes through a bunch of other measurements and metrics and parameters. You can see all of that in the article over here at the Messari website, evaluating validator decentralization, geographic and infrastructure distribution in proof of stake networks. Check this out. A lot of people today are feeling like they've been lied to. This post says, look at the Bureau of Labor Statistics Q4 22 revisions. So the quarter ending last December, there are a bunch of revisions to the numbers from the Bureau of Labor Statistics. Astronomical drops in real hourly compensation, affirming what the sentiment numbers have been telling us the whole time. We are living in a recession. And look at how big these changes are. So these changes are percent change from the previous quarter at annual rate for fourth quarter 2022. So I believe that the change from Q3 to Q4, and then they annualize that in terms of what the rate would be on an annual basis. And the changes are huge. If you look at some of these, they go from positive 0.7 to negative 4.7. So we're going from almost positive 1 to negative almost 5. That's huge. Obviously, that's non-farm business, but some of these other ones also very big. We go from a change of almost 0 to almost negative 5.5. These are so big, and obviously you could argue that this is intentional, misdirection, intentional misinformation, or maybe it's just due to the difficulty of the data collection that the Bureau of Labor Statistics encounters. But what definitely seems to be true is that you can't trust the numbers they initially publish. Whatever numbers they initially publish, which are these down here, the ones that are not in yellow, if they tell you it's a almost positive 1% change, it might actually be an almost negative 5% change, which are two completely different worlds. So it looks like we cannot trust what the Bureau of Labor Statistics puts out originally. You have to wait for their revisions, which might be substantially worse. Finally, if you find yourself being kept up at night with the question, has Cardano gone far enough north? Have we headed close enough to the North Pole? Have we gone far enough up there? That question is now answered. Laponia Pool says, we are proud to announce that we are forever written on the Cardano blockchain. We validated our first block. Has there ever been a block validated higher than the 65th North Parallel? It would make it the northernmost validated block. And Laponia, if you go to their profile, brands itself as the Cardano stake pool operating in the Arctic. So I looked on a map, and I believe this pool is in Sweden. And if you look on a map, the 65th North Parallel does, in fact, sort of intersect Sweden very, very far north. So the question is answered. Have we gone far enough north? I think we have due to this pool. I hope you had a great week. I hope you're looking forward to a fun, springish, summerish, whatever it is in your neck of the woods weekend. I hope you got some fun plans, and I will talk to you soon.